Welcome to This Explainer. Today, we're diving into one of the most misunderstood and frankly, kinda scary sounding words in real estate, amortization. If you're a first-time homebuyer, or hey, even if you've had a mortgage for years, wrapping your head around this concept is absolutely crucial. We're gonna break down exactly how this whole system works, and more importantly, show you how to beat it so you can own your home years sooner and save a literal fortune in the process. So, have you ever looked at your monthly mortgage statement and just felt a deep sense of frustration? I mean, you're paying thousands and thousands of dollars, especially in those early years, but your actual loan balance, it feels like it's stuck in a black hole. It barely budges. Well, it turns out there's a very specific mathematical reason for this. It isn't a mistake, and it is definitely not an accident. Here's our roadmap for today. We'll quickly cover the mortgage black hole, break down principal versus interest, explain the schedule, compare loan terms, reveal your secret weapon, and then wrap up with some key takeaways. All right, let's jump right into section 1, the mortgage black hole and what amortization actually is. At its absolute core, amortization is just the process of paying off your home loan over a set period of time through regular, equal monthly payments. Think of it as your ultimate financial roadmap. So if you take out a standard 30-year mortgage, your amortization schedule is that exact 30-year timeline. It tracks how every single payment you make slowly chips away at your overall debt while simultaneously building your ownership stake, which is your equity, in the property. It's literally the journey from owing the bank hundreds of thousands of dollars to owing them exactly zero by the end. Now, you might be wondering, why is it set up this way? The real why behind this fixed payment structure is budgeting consistency. Lenders use it to calculate a monthly payment that stays exactly the same for the entire life of a fixed-rate loan. It's perfectly calibrated so you hit a zero balance on your final payment date. And honestly, this is a good thing. It protects beginners from being hit with massive, totally unaffordable payments right at the start of their homeownership journey. Moving right along to section 2, principal versus interest and where your money actually goes. To really understand this, we need to look at the stark contrast between these two opposing forces in your monthly payment. The principal is the actual money you borrowed to buy the house. Every time you pay down the principal, you're building your actual ownership stake. You're basically paying yourself. On the flip side, interest is just the fee the lender charges you for the privilege of borrowing their money. You can think of it as the bank's profit margin, and unfortunately, paying it builds absolutely zero equity for you. Just look at how massive the interest chunk is in a typical early 30-year payment compared to that tiny little principal piece. In the beginning, because your total loan balance is at its absolute highest, the interest calculated on that balance is also at its peak. Since your total monthly payment is fixed, the lion's share of your money just gets eaten up by interest. That's exactly why your equity barely moves in those first few years. It's a tough pill to swallow, for sure. Okay, section 3, the schedule explained. Let's look at this 30-year journey. On a typical 30-year journey, you start at year 1 with that initial sticker shock, where almost all your cash goes straight to the bank's profits. You kind of just grind it out for years until you finally hit what I like to call the magical tipping point. And get this, on a standard 30-year loan, you might not reach this milestone until around year 18 or 19. Crazy, right? But that is the exact moment where the scales finally tip, and more of your monthly payment actually goes toward your principal than toward the interest. From there, you rapidly accelerate toward a zero balance at year 30. The reason this acceleration happens is super important to understand. Every single month, as your principal balance drops, even by just a tiny bit, the interest for the very next month is recalculated on that new, slightly smaller amount. It creates this awesome snowball effect. Because the interest charge shrinks a little bit every month, a little bit more of your fixed payment can flow straight into the principal. That's why your debt starts to disappear so much faster toward the end of your term compared to the beginning. Let's talk options in section 4, comparing loan terms, specifically 15-year versus 30-year. The absolute biggest factor in how much interest you'll ultimately pay is the term of the loan you choose. When we compare terms for, say, a $150,000 loan at an 8% interest rate, the differences are just staggering. If you go with the standard 30-year mortgage, sure, you get a lower monthly payment, but your total payout over time is over $396,000. But if you choose a 15-year mortgage, your monthly payment will be higher, but your total payout drops to just over $258,000. Plus, on a 15-year term, you reach that critical tipping point we just talked about by year 3 or 4 instead of year 18. You drastically cut down that slow, painful amortization process. I mean, look at this number. By choosing a 15-year term over a 30-year term, you save over $130,000. That is life-changing money, guys. We're talking retirement money or paying for college outright, saved simply by shortening your loan timeline and getting ahead of the interest curve. But what if you already have a 30-year loan and want to save some cash? Well, Section 5 is for you, the secret weapon to hack your schedule. Just because your amortization schedule says 30 years doesn't mean you're locked in a cage and legally obligated to take that long. Your schedule is not set in stone. Because interest is constantly recalculated based on what you actually owe, any extra payment you make toward the principal changes the math in your favor immediately. It lowers the balance, which lowers next month's interest charge, which means more of next month's standard payment goes to principal. It is a brilliant compounding effect. Let me give you a real-world example of how insanely powerful this is. If you commit to making just one extra monthly payment a year on a standard 30-year mortgage, you can shave 4 to 5 entire years off your loan term. Seriously. And by doing that, you can save over $100,000 in interest charges over the life of the loan. One single extra payment a year, that's all it takes to completely alter your financial timeline. Now, before we move on, we need to clear up a massive myth. A lot of folks think refinancing is always the magic fix. Actually, scratch that. It can sometimes be a trap. While extra payments immediately change the math in your favor, refinancing resets your amortization clock completely back to month 1. So if you're 10 years into a 30-year loan and refinance into a new 30-year loan just to get a slightly better rate, you are throwing yourself right back to the beginning of the schedule, where your interest costs are at their absolute peak. All right, let's bring it all home. Section 6, Key Takeaways and Actionable Steps. First up, some practical tips. Before you start writing extra checks, you gotta check with your lender to make sure you don't have a prepayment penalty. Most modern loans don't, but it's always smart to verify. Second, when you do pay extra, you must clearly specify to your mortgage servicer that the extra money is to be applied strictly to the principal. Don't let them just push it forward to pay next month's interest. And finally, always check your monthly statement. Verify that your extra payments are being routed correctly so you can literally watch your equity grow. To sum this whole thing up, amortization is really just the math behind paying off your debt over time. The system is set up so that your interest payments are heavily front-loaded in the early years. That's the price for maintaining a consistent monthly payment. But by shortening your loan term from the start, or by using that secret weapon of making extra principal payments, you bypass the worst of the front-loaded interest and save yourself an absolute fortune. Understanding amortization is honestly like having a cheat code for your finances. It completely changes the way you look at home ownership. So I'll leave you with this question. Will you stay a passive borrower, letting the schedule dictate your life? Or are you going to use this knowledge to actively build your home equity faster and take total control of your financial future? Thank you so much for joining me for this explainer. Keep asking questions, keep learning, and I'll see you next time as we continue to break down the complexities of the real estate world.